So yeah, Manny, thank you once again. Been a while since we chatted, and it's probably lockdown once again. So funny how things turn out. But
Yeah,
we've been over, I guess, an overview of the fund before. But I think it's just an important point to touch on with this new note issuance. So would you mind just giving me again and everyone listening an introduction to Flagship and how it's differentiated from peers in the large to medium cap mandate sphere for these LICs and LITs.
sure, Hayden, and thanks for taking the time to interview me again. I really appreciate it, and thanks to Bell Potter for the support over the years. It's different in a number of ways. One is that we are unashamedly a manager that gets put in the growth bucket. So we are picking growth companies. We're not a value manager by any stretch of the imagination. We also have structured flagships a little differently to the others in that there is no management fee. There's purely a performance fee, and the performance fee only gets paid if there's a positive return over the 12-month, over the financial year. So if the markets or our investments go south, the manager actually gets zero. And the manager provides not only the investment capability, but also the administration. So it's really unusual in that respect, because normally there would be a fee to cover the admin and all of the ongoing company secretary stuff, whereas in this one, there is none of that is covered. It all comes out through a performance fee. So in that respect, it's different. It's a concentrated portfolio of probably less than 30 stocks in the portfolio. In terms of overall philosophy, one of the differences is that we had one rights issue some years ago, and there were a number of shareholders who couldn't follow their rights. And because they had been with us since day one, I took the view that I would never, ever do anything to the detriment of existing shareholders. It didn't matter what the price was in the market. And typically when people want to issue equity, they have to do it as a discount. It is great when the share is at a premium, and then you can do it at NAV. But if we were not at NAV, I would never dilute existing shareholders. So given that this is a smaller LIC compared to some of the others in the space, it does trade at a discount from time to time, whereas the bigger ones tend to trade at a premium, which means that issuing equity is a bit of a problem. And so we came up with this convertible note idea. But I mean, in answer to your question, it really revolves around our investment strategy and also the focused nature of the portfolio.
Yeah, fantastic. Thank you so much. And some good points there too. So we might even just get into some of the key terms of the offer, and then we'll have a bit of a chat about the implications there. So would you mind just giving us all a high-level overview of what the offer actually entails, please?
Right. So we've never had debt in flagships ever, and I'm one of those old conservative people who when times get tough, debt tends to come around and bite you in the rear end. So this is a first time for us to take on debt on the balance sheet. And when we considered it, it was because obviously out there, interest rates are close to zero for, the old punter. And they're looking for opportunities where they need some fixed income or some guaranteed income over a period to pay the equivalent of a pension or whatever. So the kind of new investors who we're looking for are typically those that are looking for fixed income type of returns. So we then had a chat to the joint lead managers and said, listen, we're interested in doing a convertible note because we can actually do it at NAV. And that's why it's a $2.70, because that was the last NAV. So there's no dilution to existing shareholders. And then when we decided to look at the return of 5.5%, we said, look, we don't want to, again, disadvantage existing shareholders, but given that it's fixed for a 5-year period, well, there is a step up to 6.5. But so we struck it so that it would be close to the grossed up dividend yield on the stock. So it would be kind of like our existing shareholders would be ambivalent to whether they own the ordinary shares or the notes at the point of taking them up. We had to sweeten it a little because the advisor said, look, given it's a small LIC, one of the big banks, and the banks were busy raising money in similar veins, but like 2.9%. They said, look, this is the range of what we think you're going to have to strike it at to get it away. and we added a bit of additional cream on the top, and that's where we ended up with the 5.5%.
Yeah, fantastic. And as you mentioned, I think it's also something that's very attractive in the current environment. We've been co-managers on a couple of hybrid issuances, and I think just a couple of weeks ago, Suncorp was actually seeking about a 350 mil raise, and I think the distribution margin on that, just having a look here from my notes on it, was about 2.9% to 3.1% over 3-month bank bill swap rates. So, and with most of the hybrids and the banks, that'll be fully franked. But if we have a think about in comparison, that variable 5.5 to if the prevailing conditions are right, the 3-year call up to that 6.5 step. It's very, very attractive there. Really good for people who are more on the conservative side, and even just thinking about coming back to some of the performance and differentiation we were speaking about before. Flagship's a clear outperformer if you go back on historicals, and it has such a long history too. Just looking at the performance on both share price and NTA figures, clearly outperforming both peers and the All Ords. And when you have a think about, I guess, the premium at which it's set, being the NTA, the $2.70 compared to what the share price is now, I think it's very easy to think about the annual growth rate that would be required for these to be in the money. So I think there's a lot of value there for shareholders. If you think, just looking here, I think it's about 1.5% compounded annual growth to, all things being equal, to get up to that $2.70. So there's this really nice embedded option value too.
I mean,
shareholders.
You're getting a free option, and I mean, we announced yesterday, and I've just grabbed the piece of paper so I get the number right. But we released our NAV to the market yesterday, and it's 285.7. So we had a really good month through reporting season. So in terms of NAV, it's already on the right side of the ledger. And then one would hope that the discount will continue to narrow as it has over the past couple of years, because we adopted an approach of taking the DRP, and instead of issuing new shares, we would buy whatever we could in the market. As it so happens, the last dividend and this one, we couldn't get any in the market, so we've had to actually issue the shares. So it just says that it's really tightly held, which is good for us because we want long-term, lovely shareholders. I mean, people who come in and trade, I know they exist, but they're certainly not the kind of shareholders we want. We want people to come in and be with us for the journey. So all of those things have gone in our favor, and obviously somebody like yourself giving us some airtime will also help that.
And for people that might not be aware, can we just touch on where this sits in the capital structure and how Flagship can actually go about servicing those debt repayments?
Yeah, sure. As I mentioned earlier, we kind of pegged it at a similar level to the grossed up dividend or the pre-tax dividend yield. But obviously the investments that we're in, we have an investment approach where we, as part of assessing whether the businesses are suitable for us to invest in, we look for a return on equity of greater than 15%. So what does that mean? It actually means that most of the companies we invest in, albeit that they're growing companies, do pay dividends. So the dividend income that we get is by and large distributed to shareholders, and the additional 20 million that we're going to raise is going to be invested in the same stock. So the dividend income will service the interest, and it goes mostly towards paying the dividend. The manager only gets paid if there's a positive return, a capital return, or a positive performance of the portfolio. So the shareholders, in the form of dividend and unit holders, get the first bite of the cherry, and the manager only gets a bite if there's been outperformance from a capital point of view.
Yeah, spot on. And I think that absolute return as well is something that is very different from peers, and I think that does aid in servicing the debt, because I mean the track record's there, but the fact that there's no base management fee, I guess, to dilute that, and given that there's no other debt on balance sheet, it looks very attractive.
So if for argument's sake, investments in the market do go down in a particular year, All of the dividend flows that we get in go towards servicing the debt and then paying shareholders a dividend. Nobody else gets any bites of the cherry. I mean, the directors do get a small amount of directors' fees, and it's about 200 grand, but it's minimal in the overall scheme of things. Outside of that, there are no other expenses. The dividends go to service that. Whereas in some of the other structures, there is a management fee of 0.5% or 1% that actually gets serviced first, and then what's left over goes to settle the rest of it. So it is unique in that respect.
No, I think it should be great. We've seen a couple of prior issuances, I think towards the tail end of last year. NAOS has done a couple on some of their LICs, which have similar sort of market capitalisation, and they got away very successfully and pretty much were oversubscribed, and they have, I guess, similar internal rates of return. So thinking it's going to be very positive and very attractive, as we mentioned, given the current macrosphere.
Yep. No. So far we've heard nothing but positive news about it, and it's in the period that ASIC looks at the prospectus to make sure there's nothing in there that they're not unhappy with, and then from Monday the offer opens. So we're looking forward to, but it seems like it's been very favorably received up to this point.
All right. Well, great. Thank you very much, Manny. I'll let you get back to your day. So thank you very much again for taking
a pleasure, Hayden.
Chat.
And always a pleasure to talk to you and anybody at Bell Potter. So thank you.
Great. Thank you very much. Appreciate it.